Hi, this is Jay Hummel. Welcome to the Deep Dive. Excited today to have a good friend, JD Gardner, CEO and founder of Aptus. JD, welcome to the show, buddy.
Thanks for having me, Jay. Good to see you.
Hey, man, how's the new year? Off to a good start?
Oh, it's started with a bang. We didn't ease our way into the year, that's for sure.
Just tell the people watching a little bit about you and your journey and a little bit about Aptus.
Sure. So started Aptus in 2013, and the real simple, we exist to help kind of rethink portfolio construction in today's market. Specifically, and maybe to start with kind of a bigger statement, but we are trying to alter allocations. We're trying to create solutions and strategies to alter asset allocations to help investors not have their purchasing power stolen from bonds. And that's kind of the heart of what we do, is to impact allocations through options-based strategies.
And so what I wanted to talk about today, because I've read a lot of your publications, white papers, blogs, listened to you on podcasts. You're talking a lot about buffers in buffered products. You simplify that concept of buffers and how you're thinking about it. What is it? How do they fit in portfolio construction?
Yep. So we think of buffers really as a tool to help the asset allocation adjust. We always say we want more stocks, less bonds, but we want risk to be neutral. And we think buffers are a tool to do that. I do think that there's some misconception about kind of how to do that, what they are, where to pull from. But that's call it a $100 billion complex at this point, talking about like the 40s Act ETF kind of buffered space. That's, the smart people are saying it's going to be 6, 7, 800 billion in the next 4 or 5 years. So there's going to be a ton of growth, and it's cool from our seat. We're part of it, but you're seeing tons of innovation in that space, and I think there's really good reason that there's demand for these type of structures. But in our opinion, the demand should be driven by the need to get away from bonds, because we have $2 trillion of deficits. We're going to print money. Bonds are not going to help you protect purchasing power, in our opinion.
Yeah, in said a simple way, I think when I was an advisor, and this was a long time ago, and people weren't talking about them as buffers at the time. They were talking about strategic products, or structured products, structured notes, structured CDs. But the concept that we were using, and I think it's what you're talking about, is we could give a client an 80%, theoretically 80% equity type portfolio, but still had the risk profile of a 60-40, because we use these risk adjusted, which now everybody's calling buffers. Am I summarizing that properly?
Yeah. So to me, this is a huge point. There's always been like the structured product space. There's always been that space, and that's usually a big bank structuring some type of outcome, and they're usually not very tax efficient. There's embedded fees that might not be like super clear. So what I think one of the biggest value adds of the specifically ETFs is the full transparency, the tax efficiency, the way that the market is creating strategies to kind of minimize some of the drawbacks of these strategies. I think that's the coolest thing that's happening in the space. Is now the structured product, folks might not love it, but I think there's like transparency, liquidity, all of the reasons that these things are resonating. And yeah, you're right. You can there's different types of buffers, but the whole idea is to say, hey, we're going to give you a very defined outcome from a risk standpoint. So you're going to know kind of what a buffer means. If you have a 15% buffer and the market's down 20, all things equal, you're down 5. If you have a 30% buffer and the market's down 20, you're not down. So what do you give up to get that protection? Obviously, you have to cap the upside. And that is, and maybe this leads to another question, Jay, but the big thing that I would stress is we view buffers as a replacement for bonds. We don't view them as a replacement for equity. We would rather own buffers instead of fixed income. And we've been screaming this since 2013. But if you look at the last 15 years on a real basis after tax, I think you'd be disappointed as an ag bondholder. And that's kind of our point. Like that should only continue given our backdrop, in our opinion.
Now, and again, I'm just tying it to structured products because I know that's where advisors' head has been historically. So most people think of, I think most advisors think of buffers being tied to a basket of goods, right? Like you used to have that point to point, you used to have monthly averaging, you'd have quarterly averaging, but it would be tied to S&P or a commodities index or something like that. So when you think of a buffered ETF, is it tied? Is it tied to a basket of goods, or is it different in an ETF structure versus how people are structuring, structured CDs or structured notes?
Yeah. So the variety there's all types of variety of buffers. The meat of the industry. So most of the assets sit on S&P as your underlying, and there's a lot of reasons for that because the way you get the exposure to the S&P, it's one of the world's biggest, most liquid markets. You can use options, you can trade options all you want. It's really easy to, price whatever you need to price S&P based. But there are going to be more flavors. Our opinion of like what makes the most sense, and this is just from, for every dollar that's exposed to the buffered space, we think the overwhelming majority is going to be, it is in the S&P 500 based things and will continue to be. I'm sure there's going to be like different niche things, but most people, like, you just don't get fired for the S&P 500 exposure.
Yeah, I think that makes a ton of sense. When you think of sort of the buffered space or how you think about risk management, does it change? Does Aptus's view or your personal view change whether we're at a market high or like we've been bouncing, up and down record highs across many indexes? Are you talking about buffers because of where we are from a market standpoint and the risk of a pullback in the future? Or do you believe this strategy fits in a client portfolio across all market cycles?
That's a good question. And this is, to go back to what I kind of barely touched on, we don't view, so market valuations, all-time highs, things like that, we're not kind of advocating for buffers because of those reasons. What we're advocating for buffers is mainly if you are a 60-40 investor, we think despite all-time highs and rich valuations and all that kind of stuff, we still think that 60%, the stocks, can actually grow. They can grow earnings, they can improve margins, they can, they got dividends, they can grow sales, et cetera. The 40% we think is really going to struggle. And I think the backdrop for that 40% is kind of the biggest emphasis of why buffers make sense. Because I can say, you might say, well, JD, the 40% is in treasuries paying me 3.5%. At least that's safe. And we would always say, if you've got a 7% fiscal deficit, how can you say 3.5% interest is safe? Because your money, your purchasing power is going to be stolen. So I would rather hold something that handicaps my upside, but gives me more equity risk. But the reason that I can hold it is because, there's this buffer in place. And not to talk too much, Jay, but
No, it's great.
The biggest thing, we've kind of spent years saying, hey, we'd rather have active management in options-based strategies. We think that's where the value in options-based strategies really shines. But what we can't overcome is kind of the marketing clarity of buffers, and that resonates. If I said, hey, Jay, here's a 15% buffer where you can kind of tell exactly what the outcome's going to be, or here's an options-based strategy that there's more complexity to it, but I think the outcome might be better, we found more people gravitate towards I understand that 15% buffer thing, and that's kind of where I want to be. And so we kind of said, all right, let's throw in the towel and let's kind of educate more around these buffers and see if we can improve the structure of them rather than just talk about purely active options-based strategies.
Well, I think it's great because it doesn't just feel active, it doesn't feel tactical, right? Because I think that's how some people talk about this category, it's a tactical decision. I love the way you started, and you do this every day, and I don't, but it resonates with me thinking about it when you say, this isn't a tactical play, we're changing the way people think about asset allocation, right? To help them better deliver a risk-adjusted return. So I like the idea of how you're thinking about changing the concept around asset allocation as opposed to this being a tactical strategy.
Yeah, and it's not even, I appreciate that, but it's not even the risk-adjusted piece. It's purely the return. And that's, I could show you a chart. We've got a cool chart where we've got in green, we've got like 15 years of aggregate bond in nominal terms. And then we got 15, 10,
I've seen
5.
that.
Yeah, so the green, the yellow is real, and then the red is real after tax. And that's kind of my point, where it's like, that's the hard part, is most investors, they see the nominal return and they're like, well, great, I made money. And then the question is like, well, have you really made money on a real basis, adjusting for inflation, and an after-tax basis? And the answer is less exciting when you look at it that way.
Well, because nobody looks at it that way. That's the reality. It just doesn't fit the way they think. The last question, JD, I always ask people, and it can be in your category or it can be just more industry-wide. What's one thing you're seeing or thinking about that you think in the industry relative to markets or other things that people aren't talking enough about or paying enough attention to?
I think we've said this a lot, and I don't want to sound repetitive, but we are so trapped in this kind of like modern portfolio, call it like a BlackRock or Vanguard world, where it's like, well, Jay, you're this age, here's a target date for you. Or in the assumptions in all of those things, risk-based models, target age, the assumptions in all of those things is I am going to have positive returns in equities and I'm going to have positive returns in bonds. And while I'm earning those positive returns, they're going to correlate in a way that benefits me from a lowering my risk standpoint. Mm-hmm. And our whole, like what we don't think is talked enough about is, well, what happens if the bonds aren't positive returning things and actually can't protect you? And we don't think that that's addressed enough. Like it's still like scratching a chalkboard to me when you sit down with an advisor and it's like, well, I just want to be safe. Let's just hold, we're going to be 60, 70% bonds. And it's like, that is the furthest thing from safe, because as kind of, we're going to run it hot. That's what the administration keeps saying. That does not mean, running it hot does not mean your bonds are going to be great investments. I'll just say that.
It's not great for monetary policy. I know, JD, people are going to want to probably talk about how they work with Aptus. How do people get in touch with you, with the team? I know you put out amazing content. How do they find that? What's the easiest way to find Aptus?
Yeah, that's the best part about, thank you, Jay. That's the best part about Aptus is the people that I got around me.
That's true.
And AptusCapitalAdvisors.com, AptusETFs.com. We've got the asset management arm. We've got the services arm. But there's really smart folks around me, and we put out a ton of content. We've got a content hub. You can sign up for that. Everything from kind of evergreen topics to the headline of the day topics. And those two sites are probably the easiest way to get a hold of us and to see some of the resources we provide.
Well, that's great, man. I know you got to run. We could talk all day. I hope I see you on the road. I appreciate you coming on the show.
Thank you. I'm sure we'll be talking soon.
Thanks, guys, for checking out the show today. We'll look forward to seeing you the next time on The Deep Dive.